When the most legendary long-term investor signals a possible retreat, smart money pays attention. According to SEC filings, Berkshire owns about 27.5% of Kraft Heinz. That stake is worth about $7.3 billion at recent prices. By the end, you will understand why this matters and how to adapt the playbook. But first, let me show you what Buffett is really doing. Welcome to Alpha Markets, where we decode the market and build your wealth. Kraft Heinz says Berkshire may sell, and the market reacted fast. Meanwhile, Berkshire shares were little changed, which also speaks volumes. To understand the move, you have to understand the man and the machine. Warren Buffett grew up in Omaha and sold small items as a kid. He studied business early and learned to love balance sheets. After college, he worked with Benjamin Graham, the father of value investing. Buffett then took over a struggling textile company called Berkshire Hathaway and transformed it. His track record is why markets listen. Data shows Berkshire compounded at a far higher rate than the S&P 500 over many decades. That gap came from patient capital, concentrated conviction, and avoiding blow-ups. He kept a long horizon, but he also kept a strict scoreboard. He treated stocks like businesses, not lottery tickets. Buffett also built a unique structure that amplified results. Berkshire became a holding company owning insurers, railroads, energy assets, and public equities. The insurance float provided low-cost funding that could be invested for long periods. That float was not magic, but it was powerful when underwriting stayed disciplined. It allowed Berkshire to act when others were forced to sell. His style is simple to say and hard to live. He looks for durable businesses, honest management, and a price below intrinsic value. He talks about a margin of safety and the cost of being wrong. He also warns about leverage, hype, and stories without cash flow. One of his famous ideas is that time is the friend of the wonderful business. But Buffett is not just a buy and hold forever investor. He has also said the first rule is not losing money. He wants understandable economics and predictable demand. And he prefers businesses that can raise prices without losing customers. That is why consumer staples once looked like a perfect fit. Kraft Heinz was supposed to be that fit. In 2015, Kraft and Heinz merged in a deal backed by Buffett. The idea was scale, cost cuts, and strong brands in every pantry. For a while, the story sounded like classic Berkshire. But over time, the numbers told a different story. But here is where things get interesting. Brands did not automatically translate into pricing power and volume growth. Data shows Kraft Heinz suffered about 5 years of volume declines after the merger. Max Gumport at BNP Paribas argues that after 5 years of volume declines, the status quo is not sustainable. That sets the stage for the split and the possible exit. Let us talk about signature wins that built Buffett's legend. He bought American Express after a scandal when others panicked. He built a major stake in Coca-Cola and held through cycles. He bought Geico and made it a cornerstone. He also invested in Apple, which became one of Berkshire's largest positions for years. In each case, he focused on cash generation and competitive advantage. What links those wins is not prediction, but process. He waited for fear, then bought quality at a fair or cheap price. He avoided businesses he could not understand. He insisted on strong returns on capital over long periods. And he let compounding do the heavy lifting. But here is what most people miss. Buffett's best moves often looked boring at the time. They were not about excitement, they were about endurance. That matters when you compare Berkshire to Kraft Heinz today. Over the past 12 months, Kraft Heinz is down 23.6%. Over that same stretch, the S&P 500 rose 13.2%. Drop a comment. When a famous investor exits a long-held position, do you treat it as a red flag or a fresh start? I read every comment. This question matters because signals can mean different things at different stages. A sale can reflect fundamentals, taxes, liquidity needs, or governance changes. Context is everything. Now let us talk about Buffett's mistakes, because they teach more than the highlight reel. He has admitted he overpaid for some deals and misjudged some industries. He has criticized himself for missing early tech shifts. And he has said that a good decision can still have a bad outcome if the price is wrong. Kraft Heinz is now a case study in that humility. What went wrong at Kraft Heinz is debated, but a few themes repeat. Cost-cutting can only go so far before it hurts innovation. Consumer tastes shifted toward fresher options and new brands. Private label competition improved, squeezing shelf space. And debt and restructuring can limit flexibility during change. And that is when the market revealed the truth. Kraft Heinz disclosed in an SEC filing that Berkshire may sell its stake. The next day, the stock dropped 5.2% and led S&P 500 decliners. That reaction shows how much investors anchor to Berkshire's presence. It also shows the fear of supply hitting the market. Now we are in the Greg Abel era. Early this year, Abel succeeded the retiring Buffett as chief executive. Investors have watched for his first defining capital allocation message. Mike Murphy at MarketWatch says selling the stake would be a first major move by Berkshire's new chief executive, as Kraft Heinz unwinds a merger Buffett-backed. That quote captures the symbolism. So what is Berkshire doing right now? According to SEC filings, Berkshire still owns about 27.5% of Kraft Heinz. The stake is 325 million plus shares valued near $7.3 billion. Berkshire stock was little changed, suggesting investors see this as portfolio housekeeping. Kraft Heinz, however, is in the spotlight as it plans to split into two companies. Bulls argue the split could unlock value. They say separating slower legacy brands from faster growth platforms can clarify strategy. They also argue each company can set its own capital allocation and marketing priorities. Bulls point to Max Gumport's view that the status quo is not sustainable, so change is necessary. In that frame, a breakup is a reset, not a surrender. Now, to be fair, bears counter that the market already voted. They argue the potential Berkshire sale signaled a lack of confidence in recovery. They point to the 5.2% drop as proof of fragile sentiment. They also note the stock is down more than 70% since the 2015 merger close. To them, that is a long-running capital allocation failure in consumer goods. If this analysis is helping you, hit that like button. It helps more people find this content. And it helps us keep doing balanced research on complicated stories. Remember, price moves are not morality plays, they are information. The key is separating narrative from data. As always, this is educational content, not a recommendation to buy or sell anything. Think of this as a framework for asking better questions. Investors might consider how ownership changes affect liquidity and sentiment. They might also consider how a split changes fundamentals, not just headlines. And this is where it gets really interesting. A Berkshire exit can be read two opposite ways. Bulls would counter that selling at current levels avoids further downside in an underperformer. They argue Buffett's philosophy includes cutting losses when the thesis breaks. They also say Abel may want a cleaner slate, unburdened by merger regrets, to deploy capital elsewhere. But there is another way to look at this. Bears would argue that a massive sale could flood the market and pressure the stock for months. The risk here is not only valuation, but mechanics. If a large holder sells, buyers demand a discount. That can become a self-reinforcing loop, at least in the short term. But there is one more thing you need to understand. Kraft Heinz is not just a stock. It is a lesson in consumer staples in 2026. The category faces shifting preferences, higher input costs, and intense retailer bargaining power. A split might create focus, but it does not guarantee volume growth. Investors might consider watching volume trends, pricing mix, and marketing efficiency post-split. How can a retail investor apply this without copying trades? First, separate the business change from the shareholder change. Second, study what the market is pricing in, using cash flow expectations and reasonable P/E ratio comparisons. Third, track catalysts like the split timeline and any disclosed sale plan. Fourth, consider position sizing and time horizon if you do invest, because volatility can rise around restructurings. Now, to be fair, there are also constructive signals to watch. A split can lead to sharper accountability and better capital discipline. Management can target debt reduction in one entity and growth investment in another. If volume stabilizes, sentiment can shift quickly in staples. But bears will keep pointing to the long decline and the risk that brands are structurally weaker than in the past. What does Buffett think about all this? In September, he expressed disappointment about the breakup of the merger he once backed. That tells you the original vision did not play out. Yet Buffett also teaches that admitting error is part of staying solvent. Abel may be operationalizing that lesson by considering an exit. And this changes everything for investors. It reframes Kraft Heinz from a sleepy dividend story into a restructuring and ownership story. It reframes Berkshire from a permanent partner into a pragmatic allocator. And it reminds everyone that even legends can be wrong on a single name. The question is what they do next. The Buffett-Kraft Heinz exit deadline shows us that discipline matters more than pride when the facts change. Share this with someone who needs to understand Buffett's Kraft Heinz exit deadline. Drop a comment. Are you bullish or bearish on Buffett's Kraft Heinz exit deadline? I read every comment. Hit like if this analysis helped and subscribe to Alpha Markets for weekly market breakdowns. Next week, we break down Greg Abel's early Berkshire playbook and why it matters for your portfolio.